So hi guys, welcome back. I know this is not really why you clicked on this video, but I just want to say thank you for 300 subscribers. It does mean a lot to me that it is resonating with quite a few people, and thank you for supporting the channel. If you have, if this is your first time, do consider subscribing. We're on our way to 500 subscribers, and that would be my next target. I just want to say thank you to everyone who's watched a video, liked a video, or even subscribed, for supporting me, for supporting something that I'm enjoying, and continuing to motivate me to continue making these videos. Anyway, that should be enough, so let's actually get on to why you guys clicked on this video. So today we're going to be looking at Palantir Technologies. As you can see, over the last 5 days, it was not a very good day for Palantir. It was down more than 10% over the last day after they released their Q3 earnings. Today in this video, we're going to be looking at those earnings specifically. We're going to be looking at their investor presentations, and then we're going to be looking at why people did, or what was good about the earnings, what was bad about the earnings, and why the stock really crashed. And then towards the end of this video, we're going to be looking at some investor analyst expectations of whether this is a small setback for Palantir, or is there something catastrophically wrong with this company that will cause this to be the end of Palantir Technologies. So if you do enjoy, consider subscribing. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So once again, just the first thing we're going to be looking at is their Q3 of 2021 financial update. So just some of the quick highlights. They can see that their Q3 revenue grew by 36% with a year-over-year growth to 392 million, up from 289 million in Q3 of 2020. The year-to-date revenue grew by more than 44%, which was a year-over-year increase to 1.1 billion, up from 771 million Q1 to 3 of 2020, which was a 44% increase there. Going down, we can see that their Q3 cash from operations was an improvement of 153 million year over year, from negative 52 million in Q3 of 2020 to positive 101 million in Q3 of 2021, which is quite a big jump and a very big positive for Palantir there. Their free cash flow as well was 119 million, representing a margin of 30%, down from up from negative 53 million in Q3 of 2020 all the way to positive 119 million, which is once again a very, very big plus for Palantir. These two are very significant highlights from these earnings. The year-to-date adjusted free cash flow was 320 million, which is a $605 million improvement year over year, and their adjusted free cash flow margin was 29% there as well. They increased their full year adjusted free cash flow guidance to 400 million plus, which is up from 300 million plus previously. So they've revised their financial year of 2021 guidance, and they've increased their adjusted free cash flow guidance, which is once again a very good sign for the company. They generated an adjusted operating margin of 30% or higher for the fourth straight quarter, which is once again a very good sign. And in Q3, their adjusted operating income increased to 116 million, which is a margin of 30% there, up from 73 million in Q3 of 2020. They added 34 net new customers in Q3 of 2021, which is a total up of 20% increase in customers quarter over quarter. This brought their total customer total to 203 customers in the last 12 months, starting from September 30th, 2021, up from 169 from June of 2021. And their total commercial customer count grew 46% quarter over quarter there as well. Their US business continues to demonstrate strong growth, with their revenue increasing 45% year over year. Their Q3 revenue grew 36% year over year to 392 million. This was mentioned previously, which was ahead of their prior guidance of 385 million, which means they just basically bet their management's guidance for Q3 of 2021. Once again, it's not a massive boost, but it is a good sign for the company. Their commercial revenue grew 37% year over year, and this is the third straight quarter of accelerating growth. The US commercial revenue growth accelerated to 103% year over year, which was massive growth, and again, a very good sign for the company. And their total commercial revenue growth went to 174 million in Q3 of 2021, up from 127 million in Q3 of 2020. Their government revenue grew 34% year over year in Q3 of 2021, and they signed new deals with the US Air Force, HHS, and the NIH as well. And they're currently recently down selected to provide the US Army Intelligence Data Fabric and analytics solution under CD2, and this brought their total government revenue to 218 million, up from 163 million a year ago. In quarter 3 of 2021, they closed 54 deals of at least 1 million. Out of those 54 deals, 33 were worth more than 5 million, and out of those 54, once again, 18 were worth over 10 million. So once again, a pretty good thing for the company. They've been creating new deals, and 18 of them were actually quite large deals. Once again, a pretty good sign. Their third quarter billings increased 56% year over year to 347 million, up from 223 million last year, and the remaining performance obligations grew 172% year over year to 874 million, up from 322 million in quarter 3 of 2020. They ended quarter 3 of 2021 with $3.6 billion in total remaining deal value, which was up 50% year over year. Once again, a very, very good sign there. And the commercial remaining deal value increased 101% year over year to 2.2 billion. Once again, as previously mentioned, they added 34 new net customers, and the average revenue per top 20 customer went up actually to 41 million, up from 31 million, which is a good sign. That means that the top 20 customers, despite only making up their top 20 customers, then the same percentage of their customers, actually a smaller percentage of the customers, because they've been adding new customers, but despite making a smaller percentage, they're still paying more and more revenue for Palantir, which is a good sign for the company there as well. In quarter 3 of 2021, their adjusted growth margin improved to 82%, and their contribution margin improved to 57%. Scrolling down, in quarter 3 of 2021, they generated 116 million in adjusted operating income, which was a margin of 30%, which was beat their prior guidance of a 22% margin. In the 9 months ending September 30th, 2021, they generated 320 million in adjusted free cash flows, representing a margin of 29%. Once again, this is all stuff you were looking ahead. Just before we finish this, in quarter 4 of 2021, they're expecting a revenue of 418 million and adjusted operating margin of 22%. For the full year of 2021, they're expecting a 40% revenue growth to $1.5 billion and an adjusted free cash flow of 400 million plus. And in a long-term outlook, they're looking at a 30% revenue growth for this year and the next 4 years combined. For the next 4 years individually, which is a 30% compound annual growth rate for their revenue. So, as you might have thought, that this was actually a pretty good earnings report. Their revenue was growing, their customer base was growing, their adjusted free cash flow was also growing. They were growing their expectations for quarter 4. Why was the stock actually down 10%? So on Tuesday morning, Palantir Technologies reported their third quarter results that ranked right up with the best of this period among defense IT companies, but it didn't offer much reason to believe that investors will need to view it as anything other than a defense IT company anytime soon. So as you might have seen, that barring the US commercial foundry growth there, majority of the growth was still coming from the government. They were still going more and more government deals, and that didn't really sit well with a lot of investors, because they can see a lot of other good government deal companies trading much cheaper, trading with dividends maybe, and a lot safer bet, while Palantir is trading at a very high valuation based on future sales, while still showing the growth that they are expecting 5 years from now. And the more government interference, the more government deals that they clock, although it might be very safe, it doesn't actually conduce to a very growth heavy tech stock that Palantir is trying to be. So what? So Palantir is best known as a company whose tech helped locate Osama bin Laden. It went public for about a year ago and immediately shot higher as the market considered the potential commercial sector applications for a data analytics tool. But throughout its nearly 2-decade history, it's been mostly focused on government contracts. But now those tend to be low margin contracts, and investors thus far have valued Palantir more like a commercial software vendor than a government focused one. And that's why Palantir is trading at a much higher valuation compared to other government focused companies. So the company reported third quarter adjusted earnings of 4 cents per share and a revenue of 392 million, matching the expectations on earnings and beating the consensus forecast by about $7 million. It has also been a tough quarter on the government side of the business, with numerous contractors reporting revenue slowdowns, but Palantir's business showed very strong resilience. The issue, though, and this is quite important, is that Palantir remains a very good defense-focused business. Government contracts accounted for nearly 56% of total sales, and this segment is growing at nearly the same pace of its commercial business. You can see that the commercial business was growing at 37% from memory, while their government business was growing at 36% from memory. So if those trends continue, Palantir will remain closely tied to the defense business for the foreseeable future, and as such, it's going to be hard-pressed to deliver the growth rate that investors envisioned when it first went public. So now what? So Palantir trades at more than 30 times expected 2022 sales. By comparison, the largest IT government vendors, including Booz Allen Hamilton, Leidos Holdings, CI International, and Science Applications International, all trade between 1.3 times or 0.7 times expected sales. Palantir is a strong company with fantastic technology, but if it doesn't show real progress soon in its transformation to a commercial IT vendor, the market will likely re-expect its expectations and valuations. The stock has been treading water for some time now, and it's actually trailing the S&P 500 year to date by nearly 20 percentage points. So just to recap, investors were expecting a lot more commercial growth, and they can only see Palantir being the growth stock that they're making out to seem if they grow their commercial sector. However, their commercial sector growth has been quite limited and has been quite similar to their government sector growth, and the more that Palantir ties itself to the government, the less growth that it delivers, and the less it's valued at 30 times expected 2022 sales. That's not a very good time to buy the company if not a lot of investors are kind of expecting positive sentiment there. So is this the end of Palantir? So this is a Seeking Alpha article written by the Value Trend, and I'll just be reading through this and giving my opinions. So Palantir just reported their Q3 earnings, beating on revenue and delivering an inline earnings per share. The stock has fallen over 9%, which was quite surprising to a lot of investors. Though Palantir's government's revenue have slowed down, it has made impressive strides in the commercial segment. You could remember back to their investor relations page that a 103% increase in their US commercial growth sector year over year, which a lot of investors are thinking is a much more important metric. However, profitability is still expected to continue to fall as more dilution is on the cards, and we'll talk about shareholder dilution later, which is a problem that Palantir is experiencing. With that said, after listening to the latest earnings call, there is a path for profitability in the long term for the company. Overall, I think the results should be encouraging for investors. Perhaps Palantir does not have what it takes to become a widely used tool for companies. Perhaps Palantir does have what it takes to become a widely used tool for companies all around the world. So just a recap of the Q3 results. For the most part, Palantir's third quarter results were very much in line with the consensus estimates. Revenue came in at $392 million, beating the estimates by between $5.5 to $7 million. The GAAP earnings per share were negative 5 cents, which is about 2 cents higher than expected. In the table below, you can see a summary of the most recent quarterly information. If you want to just pause the video and have a look, you can. Otherwise, we'll be mentioning back to this later in this article. So notably, the adjusted operating margin came in at about 30%, which is above the company's expectations that this metric would fall to around 22%. The company also posted a healthy adjusted free cash flow of $113 million, also a 30% margin as well. Though the growth was in line with expectations, government contracts were slightly underwhelming. This segment delivered $218 million in revenue, a 34% increase, but it was below estimates of almost $336 million. Most of Palantir's revenues came from government contracts, so it's understandable that investors could see this as a slowdown as a sign of concern, but this author believes that it's a very short-sighted view of Palantir. The true potential of the company lies what it can do in the private segment, and in this regard, the company over-delivered. So in the last article that he wrote, he talked about the two most important things to look for in the third quarter results: profitability and commercial revenues. And in both of these metrics, the company has delivered, which leads him to reconsider the stock, especially after today's pullback. The two things he's referring to is that their revenue grew 36% year over year to $392 million. Their commercial revenue grew 37% year over year, and their US commercial revenue had a 103% growth year over year. So commercial revenue grew 37% year over year and about 20% quarter over quarter. And as we can see from the top right chart, this segment growth has been accelerating in the last year. Furthermore, US commercial revenues more than doubled year over year. In this segment is my opinion the most important part of Palantir's growth story and long term. Ultimately, if Palantir wants to grow into its valuation, it has to become commonplace amongst the corporate sector, and so far it is achieving it. Palantir software is unequivocally delivering value to its customers, something which also evidenced by the growth in customers and average customer revenue, which is up 35% year over year. Palantir's customers are sticky and they invest more money into Palantir as it helps their software and helps them grow. We have already witnessed Palantir bring improvements into many of industries such as manufacturing, supply chain bottlenecks, and healthcare as well. And now the company is launching a specialized product to tackle one of the fastest growing industries in the market right now, cryptocurrency mining. In the earnings call presentation, Palantir's management mentioned a foundry model specialized around crypto. Their COO expressed confidence that Palantir could help these companies accelerate their growth, which could end up becoming a very, very large market for Palantir. So profitability is uncertain, but there is hope. The other metric that the author was looking at was their operating margin, and Palantir delivered a 30% adjusted operating margin. However, the company still expects margin to shrink to 22% next quarter. With that said, they heard some encouraging evidence in the earnings call, laid out a clear path to how the company could achieve superior profitability. During the Q&A segment, when asked about the differences between commercial and government contracts, an interesting point was made regarding how Palantir has been able to produce different modules for Foundry. These modules were specialized versions of Palantir software, which can be easily deployed and more easily priced. In other words, that there were a lot of room for Palantir to standardize its offerings in the commercial sector, something we've already seen evidence of. Once Palantir finds a solution for a company or a problem, it can then replicate this in a much faster way for clients or other clients or with similar challenges. This development bodes very, very well for Palantir. Ultimately, this opens the door for Palantir to scale its operations and revenue at a much faster rate than its R&D or labor costs. While Palantir will continue to run losses and dilute its shares to support growth, it can be seen that there is a clear picture of how the company can deliver its service to the market in a much more streamlined and therefore profitable way. This is another take by Jonathan Weber talking about the strong cash generations and Palantir's healthy balance sheet. So many growth companies are not able to generate positive free cash flow during their high growth stage, as capital expenditures that are needed to allow the company to grow to its growth to eat up all the company's operating cash flows. At Palantir, this is not the case, as the company has been generating considerable free cash flows in recent quarters. To some degree, this is the result of a business model that is not very capital intensive, compared to a company like Amazon, which has warehouses, trucks, and so on, although it does have its AWS, but that's beside the point. Palantir Technologies operates with a pretty asset-light business model. Its biggest assets are its data specialists and their skill sets, which is why Palantir Technologies is able to add hundreds of millions of dollars in revenue this year, despite a pretty slim capital expenditure spending, and we can see this down in May of 2021. Over the last couple of quarters, capital expenditures average just a couple of $1 million a quarter, which is not a lot for a company that generates more than $500 million of revenue growth this year alone. Palantir Technologies' cash flow statement for the first 9 months of the year looks like this, and once again you can pause and refer back to this later on in the video. The company generated operating cash flows of $240 million, with less than $10 million being put forward of capital expenditures during this period, which translates into a free cash flow about $230 million in Q1 to Q3. Even better, the company is guided for free cash flow of more than $400 million in the fiscal year of 2021, which means that Q4 will see a free cash flow total of more than $170 million at least, if we're basing it off management expectations. With strong free cash flows, Palantir Technologies is able to shore up cash on its balance sheet while investing in small companies at the same time. Palantir ended the third quarter with a cash position of $2.3 billion and no debt, which combined with positive free cash flows mean that there is a very little liquidity risk for the company should it go bankrupt or should it have to sell a part of their business away. Of course, these cash flows are not only possible thanks to the fact that Palantir continues to issue shares to its employees at a considerable pace. Share count dilution has been brought up as an argument to not invest in Palantir by bears repeatedly, and even though I do not fully agree with that thesis, Palantir's share issuance shouldn't be ignored. Looking at the average diluted share during the third quarter, we see the following, and then you can just pause this and look at it later. With 1.96 million Palantir shares, share count has been risen by more than 3% from the average during the second quarter, which makes for an annual dilution rate of well above 10%. This is of course still way less than the company's business growth rate, as revenue are expected to grow about 40% this year, which means that the per share value continues to rise rapidly. Still, ongoing share count dilution means that not all of the value that is created by Palantir ends up in current shareholders' pockets. I do believe that share count dilution will slow over time as the company gets a bit larger and gets more and more employees. They'll be less incentivized to give that much of a share count dilution to its employees. But one thing we do need to understand is that they have reduced wages, which has allowed the company to come to this stance where they're able to grow at this rate. So in the short term, I don't believe that share count dilution is a very big threat, but should this continue for over the next year or so, it could become a problem in the long term. But as long as growth rate outpaces their share dilution rate, it is not a very, very big problem for Palantir. So just looking at a lot of long-term potential. So Palantir has guided their quarter 4 revenues above consensus at the $418 million versus the $402 million, which fits well with the fact that analysts have a history of underestimating the company. For fiscal year of 2021, it means that revenue will total at least $1.5 billion. More importantly, the management has reiterated that they see revenue growth of at least 30% a year through to 2025, which pencils out about $4.3 billion 4 years from now. Due to the at least portion of the management's longer term guidance, and since Palantir has a history of under-promising and over-delivering, one could make the case of maybe a 35% annual growth rate, which might make for a more realistic scenario. In that case, the revenue in 2025 could come at close to maybe even $5 billion. Even beyond 2025, Palantir's growth rate is what the author believes will remain attractive. Data analytics will be a steady growing market for many years to come, and due to its moat and great connections with both commercial customers and government and / public customers, Palantir should be able to capitalize on that growth quite easily. On top of that, at about $5 billion in revenue of 2025, Palantir is by far not yet at a point where its huge size will prevent it from racking up compelling growth beyond that point. If the company adds another 25% a year to our $5 billion estimate through to 2021, its revenue could become at close to $19 billion a decade from now, and put a Microsoft-like 13 times sale multiple on that, Palantir could be worth at more than $250 billion a decade from now, which should mean a 400% increase from today. And even if Palantir's share count rises 5% a year for a whole decade, Palantir's per share value could still climb 225% in this scenario. When we consider that Palantir growth could come ahead of expectations, or that Palantir might be valued at a higher multiple than Microsoft's current price to sales ratio, the returns could be even higher. So overall, the author believes that Palantir is an exciting long-term investment that could deliver considerable returns over the coming years and decades, although investors should keep an eye on share count dilution issue. On top of that, Palantir has a tendency of being quite a volatile stock, which is why it's not a suitable pick for everyone. The volatility is showcased by the fact that Palantir trades 9% at the time of writing, despite the fact that it was a beat and raise quarter. To me, this looks like a market overreaction that provides quite an attractive entry point relative to where the shares have traded in the recent past. So while I agree with these last two articles to quite an extent, I do believe once again we need to look at their commercial growth. Palantir in quarter 3 did not deliver the commercial growth that investors wanted to see. It did beat expectations, and it did grow a considerable amount, 37% compared to last quarter, but it did not give the expectations that investors were looking for. And if it consistently does this, you can make the case that Palantir is kind of done and dusted now. The share price is far overdone, and it will kind of just become one of those government agency kind of companies which trades at a very cheap valuations but doesn't have a lot of growth as well. So I do believe right now Palantir is not in a terrible spot. I do believe the 9% is quite a big overreaction. And just coming to the technical analysis, you can see that this 9% drop brought Palantir all the way down to its 200-day simple moving average, when we've seen basically since August, the 200-day simple moving average has been seen as kind of a baseline for Palantir. It kind of hit this back on 6th of August 2021, rebounded all the way back up. It hit it on the 4th and the 11th of October and went all the way back up, and it kind of rebounded back on the 10th or the 9th of November, and is currently trading at the 200-day simple moving average. So I do believe it is quite a big overreaction, especially for an earnings that overall was quite positive for the company. But once again, it is very important to look at their commercial growth rate and their foundry growth rate, and slowly, maybe over the next 2 quarters or maybe the next year, I would think it would be very, very good to see if Palantir reduces their requirement of the government and kind of establish itself as more of a commercial player. I do believe the 9% is quite an overreaction, and I would recommend buying Palantir at $23. We can see the stock traded close to 26. So even if we're not looking at long-term growth, I do believe there will be a short-term increase, maybe to $25, $26, and you could make a small short-term play there as well. So that brings me to the end of this video. If you do enjoy, consider subscribing. Today we looked at the investor relations page. We looked at why the investors were not too happy, and then we looked at a case for why Palantir could be a market-changing company in the future. If you made it all the way to the end of this video, do like and subscribe. Let me know what you think of Palantir, and I'll see you in the next video. Bye.